with me. Anyhow, I'm so excited, Luigi, to have you on for this morning's Friday morning chat with Angie. You are a wealth of knowledge when it comes to finances, and I thought it was a great opportunity right now on our fourth episode to go through budgeting with everybody, especially in this climate that we're in right now. We just found out that job loss is an all-time high, of course. I mean, that doesn't even account for the people who had to go part-time and had to reduce their hours, and income is less and all that fun stuff. But yeah, let's put us on a path of success here. I know that's your forte. So welcome to our fourth episode. Where should we start here with you, Luigi? Give us a little bit of background on where this all began.
So let me first say that I'm really excited and honored to be here today. I've been following your chats for the last few weeks, and they've been a wealth of knowledge, and I've been actually incorporating a lot of the stuff that I've learned into my own personal life. So to have this medium and this opportunity to chat with you is pretty awesome. So thank you for the opportunity.
You're really welcome, Luigi. So with your experience, what's happening right now? Why should we not be scared? Like, what should we be planning for?
So should we not be scared? I mean, it really, we're all going through a very interesting time right now, obviously. And should we be scared? Should we not be scared? I mean, the reality is, as long as you have your plan set in place and you know what your vision is and where you want to go, then you shouldn't be scared about the short term. It's more of a long-term play. And we'll talk about that, I'm sure, later on in the discussion.
Right. Yeah, Luigi, I often get people confused with your position or positions in the field. Like, what is the difference between a financial planner and an investment planner? And where do you fit? And where do you fit in that?
So the reason why I got into this industry is because of that great area. And everybody, tries to figure out everybody wants to be wealthy and everybody wants that financial independence. And really, the reason why I got into it is because I dealt with some personal issues myself. I obviously made some really good investments earlier on in life, and some not so good investments later on in life, and had to learn the hard way. And unfortunately, I had to learn that way, and that put me on the path to want to have or help individuals not deal with the same ups and downs that I did. And just to get back to that question, the big point of clarity is that a financial planner versus a financial investor, there are clear distinctions. A financial investor deals with investments and advises you on investments and an investment strategy, whereas a financial advisor advises you on a holistic plan for your life to make sure that you have got the pieces of the puzzle and the blocks in place to build that house. So they look at things holistically from a foundation perspective, and then build the building blocks on top of that. So just to give you an example, so securities, when it comes to your financial independence and your plan and your trajectory, 10% of your plan is accounting for what investments to invest in. Another 20% is asset allocation, but the big part that financial investors are missing is the 70%, which is putting the pieces of the plan together. So looking at the greater picture, is there an opportunity to maybe look at tax efficient strategies? Do you have the right fundamentals when it comes to your goals? Do you know what your goals are? Do you clearly have those goals defined in order to make sure that the plan is put in place to achieve those goals? So 70% of it is not accounted for, and believe it or not, a financial advisor as well as a financial investor, they get paid the same amount of money for the work that they do. So that being said, you can either go to a financial investor and pay the same price that it would for a financial planner to put your plan together.
Right, right. What would you say? What's the difference between yourself and say someone who's at the bank? You know, yeah.
I don't like to downplay anyone specifically. I mean, banks are fantastic at what they do. Banks are great at lending money, but they don't look at things holistically from a high level perspective in terms of what your vision is, what your goal is, and making sure that you're on the right path.
Yeah. I'll
just leave it at that. How about that?
That's perfect. I mean,
yeah.
That's been my experience as well as a mortgage broker. As you know, we love banks. We use them all the time. But I think we need to solicit our experts that go above and beyond the paycheck. And that's why I love working with you, Luigi, because you're not just looking at the client for that paycheck, as you had mentioned. You go above and beyond with that holistic plan, which I
and we'll talk about the different components in a bit about a financial plan itself. But just talking to what you just mentioned, when it comes to being vested or wanting your clients to succeed, first of all, if you walk into a bank, will a bank know your name? Just walking into the bank and seeing your advisor at the bank, maybe not. I'm not really sure.
Yeah.
I just recently finished a plan where I incorporated someone's vision to have investment properties, right? And if you go into a bank, would they really necessarily put together a plan that would incorporate that strategy? Because that's really what you want, and that's really what you want to achieve. That has to be part of your plan.
Yeah, I agree. And we deal with a lot of people who buy investment properties, and as you know, we refer them over to you. Right. I'm a strong believer, huge believer in that holistic plan and putting together a just being diversified and coming to me first. It won't really make sense because I don't get the whole background, and that's why I love working with you, Luigi. Let's move forward. Let's talk about that plan. Like what is a financial plan? Let's talk through that.
Yeah, so a financial plan is made up of essentially 6 different components. First and foremost, you need management of your cash flow. So cash flow is super important because if you don't manage that cash flow, you have no way of knowing or no way of capturing a savings strategy, right? So are you taking advantage of the potential tax planning strategies? What's your cash flow analysis? Do you have a savings strategy? That's first and foremost. Secondly, you need to look at securing your retirement. So when it comes to your retirement, do you know what that looks like? Do you have an idea of what your retirement goals are? And moreover, if you do have a vision of what retirement's supposed to look like, how much of an income is going to be required in order to live that lifestyle, right? So if you know that it's going to cost you $10,000 a month in retirement or $5,000 a month in retirement, that's a good starting point. But the question then becomes, how much money do you need saved? How much of investable assets do you need in order to support that income, right? Now, another component to look at when you're talking about securing your retirement is how long is your retirement going to last? So when you're looking at how long retirement's going to last, on average, if you're in a relationship, on average, one of the 2 individuals is probably going to live 50% longer. That's what statistics show today. So if you plan on retiring at 65, your plan or retirement plan should last until around the age of 90. So 90 years of age. So you're looking at 25 years of retirement income that has to be planned for. And I'm not trying to scare you here, but these are realistic numbers, right?
You find that most people are off with that? Like, do they even have this goal? Like,
yeah, so they say statistics show that about 80% of people that are approaching retirement feel that they are not prepared for retirement. And moreover, if they could go back and do it earlier, they would have. And it's unfortunate, but I mean, that's why financial advisors are here, is to make sure that you have those pieces in place to make sure that you achieve those goals, right? It's never too late.
I was going to say that. Yeah.
You're right. It's never too late to analyze your path and put you back on that path again, right?
Right.
The third thing I wanted to bring up was preparing for the unexpected. And that's the one that nobody wants to address. And that's your biggest asset in life, pre-retirement, is your ability to earn income. So you need income protection. So you need to protect yourself. You need your family, your loved ones. It's not a fun conversation to have, obviously, with clients. But the analogy I always say is, if your husband or wife were to jump on a plane for a business trip, and even though we can't do that nowadays, but if your husband and wife were to plan on jumping on a plane for a business trip, if that plane didn't come back for whatever reason, what would your family nucleus look like?
Right.
How much would you want to protect that? And that's a really, really important question that everybody has to ask themselves. And that's one of the foundation questions that we need to really address when it comes to putting the financial plan together, is making sure that we have the insurance to protect our loved ones, and make sure that if anything happens, should the awful event that anything should happen, I mean, you want to make sure that your loved ones are protected. So that's number 3.
Yeah, that is such a hard conversation with clients, that when I sit with them, I have to mention to them, as we increase our debt, you should be revisiting your insurance, your liabilities, and all of that with an insurance broker. But I love that you're like a one-stop shop where you're looking at the whole person and their whole life, which is
right.
Right.
Well, it's funny that you say whole life, and that was a great segue. But types of insurance plans, right? So you have an insurance plan which protects your earning power or earning potential, so your income.
Yeah.
And later on in life, when you hit around 50 to 60,
long time for me.
Protection, right? You need to protect that wealth that you've accumulated. So when you start planning for your estate plans, you need to make sure that you're preserving wealth for your family so that they're not hit with a big tax bill come tax time. So there's 2 aspects of insurance. There's insurance that protects your income, and then there's insurance that protects your wealth. So depending on what stage of life you're in, it really depends. But yeah.
Right. That's a really good point.
So the third pillar is...
I think we're at 4 now.
Oh, sorry. Yes, 4. Yeah.
Now we're at 4.
Yeah. Okay. Great. Keep it on top of it. That's good. So the 4th pillar is giving back, and that's making sure that you have the right plans for an estate, and knowing what your potential exposure is, which led to the insurance conversation there, which ties in nicely. Is the estate and trusts? Does it make sense to have a trust? What are your estate plans? What does your estate look like? Do you want to minimize that impact, that tax impact that you're going to be passing on to your loved ones? And do you have any plans for philanthropic, donations? Do you want to leave a legacy behind? What do you want to do for that? So we can also help with putting those pieces of the puzzle in place.
Right.
Okay.
Awesome. Yeah.
All right. So then we go to number 5, which is planning for major expenditures. And that encompasses everything from, your children's, if you have children, we look at what it's going to cost for university. Most people are pretty surprised at what the university costs are. But just on an average, if you plan on sending your kids away to university, you're looking at about $17,000 a year, what you should earmark. When you look at $7,000 for tuition, books, food, living expenses, you should earmark about $17,000 a year for tuition and expenses. And I mean, it's overwhelming to look at, but those are realistic numbers. And
20,000 for us. It was 20,000 per year per child. And at one point, there may be two children in the household at university at the same time, which
Yeah.
happened to us. It's
Right.
yeah.
And are you taking, and the question is, are you taking full advantage of some of the government grants that are out there, right?
Right.
Ps offer you an incredible uplift as long as you're meeting the minimum requirements in terms of deposits for the year, right? So
Yeah.
take advantage of all the options that are out there.
Gosh, I wish I had known you before, Luigi, because we had no idea that there's actually free money. There's grants out there. You just need to apply for them, and every little bit counts. Like 20 grand a year is a lot of money to plan for.
Yeah, absolutely. I'm going through it myself, and fortunately, I'm in the position that I'm in, being a financial planner. So we took the necessary steps ahead of time, and we're making sure that it's not going to be a big burden when he goes to university. So, well, that's if he goes to university. Let's just put it that way.
But you need a plan for it.
Right, right. And so those individuals who don't have a child that's going off to post-secondary school, there's the flip side. And we talked about this a few minutes ago with in terms of major purchases. Do you want to buy a cottage? Do you want to, maybe upsize or downsize your house? What are your short-term, long-term goals for purchasing, right? Yeah. For purchasing anything. And as we talked about a few minutes ago, I had a client very recently who was interested in, investing in property and making sure that we put the fundamentals in place to make sure that they were able to achieve that.
Right.
Right.
Yeah.
So making the purchases, major purchases. And then lastly, if you are self-employed, if you have a business, do you have tax planning strategy? And I get this a lot. Does it make sense to incorporate? Does it not make sense to incorporate? When it comes to taxes, how can I minimize my tax impact every year? Do I want a tax strategy? A big misconception that people have is that accountants are fantastic, but accountants are extremely busy. The onus is on yourself to make sure that you have the right plan to make sure that when it comes tax time, you took the necessary steps to minimize your tax impact and take advantage of those tax strategies that are out there. So accountants are fantastic, but their role is not to make sure that you put the best foot forward. Their role is to make sure that the ledger and the pieces of the puzzle are in place once you submit your taxes. They plan together. My role as a financial planner is to make sure that I holistically look at things from 10,000 feet and talk to both a lawyer as well as the accountant to make sure that the plan is put in place and it makes proficient sense.
Yeah, yeah. You bring up a really key point, that power team. Like it's so important to know the right people and have the right people in your corner. And I think that's another reason why I think our connection works so well is we have that power team and use each other and sort of be in the know with the one client. It's seamless.
Yeah, absolutely. I mean, power teams are so important, and I struggle with how to articulate this to people all the time. Because if you're in business, you understand the value of a power team. If you're not in business, it's really hard to understand how important it is to have the right power team surrounding you to make sure that you're making the right decisions for yourself and for your family. So do you have an accountant that you can rely on and trust? Do you have a lawyer that you can trust? Do you have a financial planner that you can trust? Do you have a mortgage broker that you can trust? Right? And these are very, very important aspects to any living plan. And everybody should really look at what they have and the people that they have surrounding us. I know my parents would always say to me when I was young, if you want me to know who you are, show me a couple of your friends.
Yes.
And the reality is, if you don't have those trusted advisors around you, how are you going to make the right decisions moving forward?
I agree 100%.
Yeah.
Yeah. Yeah.
you know, a few books that I read, Rich Dad, Poor Dad was one of the ones that I read when I was a teenager. And that's, I mean, that's not a financial advisor book, but it's an investment advisor book, if you will. And it's more of a real estate investing platform. But what he talks about over and over and over again, and that's what really drew me to that book, is his power team, right? It's super important to make sure that you have a power team where you can go out, ask the questions, and then make an educated decision based on those answers and those responses. Yeah. Super important. I can't.
I love Rich Dad, Poor Dad also.
Yeah.
Yeah.
Super important. Super important.
Awesome. Let's talk more about our budgets now, and yeah, let's.
So when it comes to budgets, so that when you walk through the process of putting a plan together, a lot of times, actually, I'd say a good over 90% of the time that I talk to clients, they don't necessarily have budgets in place. One of the thought-provoking questions I always ask is, let's look at what you spend a month, and let's dive in and see if it makes sense, right? And most people don't know off the top of their head how much they spend, so they rattle off some numbers. And what makes IG and the software that we use really unique is that it offers us the opportunity to spit out what your disposable income is and how much of that is being spent up, so we know what your discretionary income is. That being said, what we subscribe to and what I try to pass on to my clients is the 50-30-20 rule. Okay, so 50% should be spent on your normal expenditures. So 50% of your income should be.
Sorry, what's normal expenditure?
So that would be your living expenses, your house, your car, things like that. Okay.
With mortgage, with
all of that. Yeah.
So regular, just living expenses. Okay.
Right. So 30% of it should be discretionary. What you want to do for fun, Netflix, going to the movies, just going to restaurants, things like that.
Okay.
And 20% of it, which is the hardest to do, is you need to make sure that 20% of it is being saved. So it needs to be put aside. And it sounds like a huge number, but when you start to do that, you need to pay yourself first. Because when you start to spend all the other money, it's really, really hard to make sure that you're saving that 20%. But if you get paid and you pay yourself first, that 20%, put it aside, you start to get accustomed to that lifestyle, and you're always paying yourself on a monthly basis. And you need to pay yourself first to make sure that you're taking full advantage of your budgeting opportunities there.
And I would say with that, like the 20% that we are putting aside, not only will it allow us for that rainy day or down the road,
right,
growth, also gives you that positive feeling that the growth feels good, instead of always feeling like all you're doing is paying out.
Right, and nobody knows it more than everybody right now on how important it is to prepare for the rainy day, right? Because everybody's experiencing the rainy day right now. So
yeah,
I mean, this should be an exercise that we all kind of address. The funny thing is, I find with clients, the ones that make the most money, obviously spend the most money, it makes sense, but are less likely to end up saving or realize the importance of that 20%.
And why is that? I have a feeling I know, but what do you think?
I think it's because subconsciously the money is there and it'll always be there.
Yeah.
But I tend to find that the individuals that make more money, whether they're professionals, whether they're just high income earners, whether they have a successful business, they're used to seeing a lot of money coming in. So they end up spending a lot more of that money, and that 20% becomes more and more difficult to save, and it doesn't become an issue until later on in life.
Yeah. It's funny because week one of COVID, you know, and the influx of calls that I received about that mortgage deferral, I realized how many people do not have that, 3 to 6 month buffer
Yeah.
set aside. Very scary, very scary.
Yeah, and everybody needs that. That's part of putting the financial plan together, right? When it comes
Yeah.
to, you need to budget and save 3 to 6 months. So you need to have that as a plan, whether it's in your business to have your business float, because nobody would have thought COVID or a pandemic would have hit. And
Mhm.
those restaurateurs that probably don't have 3 to 6 months worth of savings saved up now. And how is the world going to look coming out of this? Based on that, right? Are those
Yeah.
restaurateurs going to be able to survive without having the plan in place? It makes it that much more challenging to plan for those rainy days.
Yeah, for sure. And like you said earlier, I don't want anyone to be afraid that they haven't started a plan or they haven't come
No,
to
no, no.
like no better time than now. Like
Right.
take this as a learning experience and a
Yeah.
wake up call to say, all right, I didn't have the savings. I need to have the savings.
Yeah. I didn't want to come across as if I'm bearing all bad news.
It's not. It's
Never
not.
too
This is
late.
great.
Yeah, it's absolutely never too late. But it doesn't hurt to have somebody tap you on the shoulder every so often and just kind of remind you that, it's good to plan. Whether you're a professional, whether you're, um, you know, in any employment, everybody's got to put a business plan together. Whether you're a salesperson, whether you're a professional, you always need a sales plan. What about your own personal plan?
Mm-hmm. Yeah.
It's really important to look at it that way.
Yeah. So I had interrupted you. You're talking about the 50/20/30 rule, and then we went into the 20 rule with the savings.
Yeah.
So sorry, go ahead.
No. So you just want to make sure that you're paying yourself before everything. That's one of the tricks to make sure that you're putting aside that 20% is to pay yourself first and then worry about all the other expenditures. If your listeners want, I can definitely share a really, really awesome Excel spreadsheet that I use that calculates exactly how much you should be spending on different areas of your income or based on your income.
Yeah.
Simply populate what your income is on the top, and then it breaks down, area of, home expenses, auto, things like that. And it gives you a good indication of whether or not you're spending it in the right areas and whether or not you are saving properly.
Well, that would be an amazing tool. Yeah.
Yeah, I can definitely share that for your listeners as well. Absolutely.
Yeah. Fabulous. Yeah. Let's do that. We're also we're recording this, so
Okay.
we'll share that as well. Victoria
Awesome.
says she'll attach it to the email.
Awesome. Hi, Victoria.
I'm still stressed I couldn't go live. Anyhow.
No, it's all good. Don't worry about it. I don't think we've dealt with the idea of planning. So we know the different components within a plan,
Yeah,
right? So how do you go about planning,
exactly.
right? So there's, again, 6, and I'll hopefully count them properly this time, but there's 6 key components that you want to deal with. First and foremost, when you sit down with any advisor, they need to, and you need to make sure that they clarify what your goals and objectives are. If you don't know where you're going, if you don't have a point of reference,
Yep.
you effectively put a plan together when it's just pie in the sky. You need to have a point of reference in order to know what track you need to stay on in order to achieve that goal. So first and foremost, you need to clarify those goals. Then you need to really sit down and analyze what your current situation is. So what are your expenditures? What are your assets? What are your liabilities? And gathering all that information and not gathering 1 or 2 little components. Advisors, in order to give the best advice, need to understand everything that's going on. I often sit down with people who have, investments in certain areas, maybe 4 or 5 different banks, a home, for lack of a better term, somewhat diversified, a little over diversified. But the reality is, in order for an advisor to give recommendations, they need to truly understand what your current situation is. And as uncomfortable as that may be, it really is important for us to put forth recommendations, because if you're hiding certain information, then you're not getting full transparency. And full transparency is absolutely imperative.
Well, I remember when I sat down with you, Luigi, for our plan, and I came out of it feeling like I was like totally exposed and naked. Remember I said, I'm like, I feel like
and
it's tough.
Yeah, it's funny that you say that. So ever since you and I had met the first time, I always preface to my clients and my prospects that, you know, when it comes time to sit down and have this conversation, I know it's going to be extremely uncomfortable. But when you come out on the other side, you'll feel so much relief.
Yeah,
you do feel so much more relieved because you understand now what the gaps are, and now that you have an understanding of what those gaps are, there's more clarity to your life, and you just feel so much more relieved, and you feel so much better about it, right?
Yeah, for sure. So number 3.
Yeah, so number 3, develop a comprehensive plan. So that's my job, is to make sure I put together the pieces of the puzzle, to make sure that every angle and every amount or every component of your plan and your vision is addressed, and be making sure that all the pieces of the puzzle from a holistic perspective are put into a plan so that it all interconnects and makes sense to you and your vision. Okay, and that's my role. So that's one that alleviates everyone from having to do anything other than myself. So that's develop a comprehensive plan. Number 4 is customize investment allocation. So part of the process when we first sit down is finding out what your risk tolerance is. You know, depending on your age, depending on years you want to invest, and depending on your risk tolerance, we really need to find out what investments you need to be put in order to achieve those goals. So does it make sense to put someone who's a year or 2 away from retirement into equities, which is a very fancy term for the stock market, right? So does it make sense? Probably not. But you'll be surprised at how many people aren't aware of where their investments are. And it's really shocking when you sit down with somebody, and I'd say a greater portion of the people that I sit down with don't really know where they're invested and why they're invested in what they're invested in. Yeah. And I like to take the onus on myself to educate my clients to make sure that they know where they're invested and why they're invested in those funds. That when they're at the cocktail parties, which will eventually come again, they're having educated conversations with their friends and maybe throwing their friends off about, you know, well, why are you invested in that? And those are, it's always nice to know that you know more about your finances. So if I can arm my clients to have those conversations, it'll speak true volumes to what I do as a professional, and it'll arm them to be confident about their future as well.
Yeah.
Right? And once all those pieces of the puzzle are put together, I present it, and we decide if, you know, which direction we want to go, and then we implement it. And making sure to implement it with what they're comfortable with, and effectively. So implementation would be the next, followed by proactively monitoring it. And that's the last step, is just making sure that you meet with your financial advisor at least every 6 months to make sure that your plan is being fulfilled. And moreover, you know, what happens today is not necessarily what the situation is going to be in 6 months. So it's really, truly important to sit down regularly with your advisor to make sure that your advisor is up to date on, you know, what's going on in your life, so that that can be incorporated in your plan moving forward, because it's living. It's an ever evolving plan, right? And so making sure that you address all your life changes is super important.
And why I love working with you, Luigi, is that, and I don't think it's because you and I know each other and have a good connection. I think it is because of who you are and how seriously you take your role as an investment advisor, is that you are in touch. You are asking those questions. People have this idea that with investments, you set it and you forget it, which you do, but don't let your advisor be the one that sets you and forgets about you.
Right.
I so appreciate that about you. And I know that you do that for many of your clients.
Yeah, I think it's super important to know what you're invested in and why you're invested in what you're invested in. Not to get into the nitty gritty about, you know, what specific, you know, ETF or, you know, what the fund that you might be invested in breaks down in terms of percentage of equities, and you don't have to know that much, but it's important to understand at a high level why you're invested the way you're invested, because you ultimately control your path in your future. I wouldn't necessarily always lean on somebody else to make the decisions on your behalf.
Right. I just want to open it up on the floor. Is there anybody do you have any questions for Luigi? We are at 11:45 right now, so you can either chime in or just write it in the chat. Otherwise, we'll keep going here. This is really great information. Anybody put a hand up? We're good. So far, so good, Luigi. Oh,
I have a question. I have a question.
Okay, go ahead, and I'll read this question.
All right, I'm going to ask myself a question. How about that? So,
okay, wait. We have.
Oh, we do have a question. All right.
We have a question. Yes.
All right.
When you say holistic, what specifically do you mean? So a holistic plan, what specifically do you mean when you say that?
So holistic plan, I don't know if you caught us earlier on, but there are 6 key components to putting a financial plan together, and it's addressing all 6 of those components, right? So I'll just rattle them off again. So it's managing cash flow, making sure that you have, you know what you want out of retirement, and that you have a clear definition of retirement and what you expect out of retirement, so that you know how much you need to save for retirement. Then covering, from an insurance perspective, protecting not only your income, but also your wealth from an insurance perspective, making sure that you're protecting your loved ones. Giving back. Do you have an estate? Do you know what your estate looks like? Planning for that. Looking for major expenses as well, right? So managing debt. If you have a lot of debt, are you managing that effectively? Do you have education plans for your children? And are you looking to, you know, purchase a house or an investment property? Incorporating that as well into your plan. And then lastly, when it comes to business professionals, do you want to incorporate, are you taking advantage of tax strategies? And then do you have a succession plan? And that is holistic. It's looking at everything, every aspect of your financial wellness, and making sure that that is addressed in your plan.
All right, thanks. There was another question, Luigi. It's a great question. So given a couple comes to you and their risk tolerance or aversion is different, so would you have them each take the risk tolerance, I don't know, test or assessment that you do?
Yeah, so it really depends on the structure of their investments. I mean, individuals should be individualized. So if I have an RRSP and my wife has an RRSP, we may have different risk tolerances. We may have different understandings of what we want to do with that money.
Right.
Taking that into account, it's a little different when you're talking about joint accounts. If the money is shared amongst the couples, then that has to be addressed individually. But every account should be addressed accordingly, because not all accounts are for the same investment types. So, so length of time of investment really plays a big role on risk tolerance. Does that answer? Hopefully that answers the question.
I think so. Does that answer your question, Kelly? You can speak. Do you want to speak? Go ahead, Kelly.
Oh, wow. I got the privilege of being unmuted. Awesome.
Yeah, well, you are, so I'll.
So yeah, it definitely answers the question. The reason I brought it up, which Luigi knows, my risk tolerance was like top level. And I know that my husband is much more conservative, right? So, you know, I think if we did have joint accounts like Luigi had mentioned, that would have shifted the way that we had set up the plan.
Right. Yeah, absolutely.
Thank you.
Awesome.
Hi, Kelly.
Luigi, we've got about, let's say, 5 minutes-ish. I know we ate into a good 5 minutes at the beginning with me fiddling around with trying to get it live. So let's bring it all together. If you have any other questions, you know, we're going to give your email and your contact info so people can contact you directly. But how do you want to wrap this up for today?
Yeah, so I guess first and foremost, I just wanted to make sure that I would advise anybody to maybe sit down with a couple of advisors, make sure that you're comfortable with the approach that your advisor is taking. Not all advisors are created equally. So I would encourage you to do that. Secondly is in terms of the investments that you look to move forward towards, make sure that diversification is top priority. When it comes to diversification, I have a slide if you want to. If
yeah, go for it.
Yeah, so do I just click share screen?
Yeah.
Awesome. So this kind of highlights the importance. Oh, that's the wrong thing. There we go. This highlights the importance of diversification. So if you look at this slide right here, on the left, you have, you know, let's say a year ago, you wanted to put all your money into marijuana stocks. It was, you know, there was no end in sight. I mean, you would put $100 in and it would turn into $10,000 overnight, or everybody would think. But if you're not diversified, you can see the pillar analogy. If you put all your eggs in one basket, if that pillar breaks, all your money is gone. Whereas if you look at the analogy on the left or on the right with diversification, if one of those pillars breaks, so making sure that, let's say you have financial investments in real estate, in, you know, mutual funds, in stocks, in a specific stock. Right now, the stock market is really highly leveraged or highly weighed on tech stocks. How long is that going to go? Are you adjusted for that should anything happen? So it's really important to diversify, and I just wanted to share that.
Yeah, that's so key. As you know, I work with a lot of real estate investors, and yeah. I can't stress how much I always talk about diversification as well. It's key. It's key.
Absolutely key.
It's all great when everything's going well and you've got your stuff, you know, you got your 12% happening, and but when there's, like, who foresaw this pandemic 6 months from now? Nobody did, and this is a great illustration of that. There's a question, Luigi, and we still do have time, so I'd love to answer it. Let me just open it up. So any advice for people and their investment right now? Lots of collapsing happens. Like, what's your feel?
So, I mean, I don't make $8 million a year, and I don't have a fund that I manage myself. So I don't have a crystal ball. And if anybody tells you what they should be investing in, and if anybody has a crystal ball out there, please tell me, because I'd love to know, and I'll sell my house and put everything in there. But the reality is you need to stick to the fundamentals, and the fundamentals are find out what your goal is, make sure that you're trying to achieve that goal, and make sure you have a path to that goal. So you need to make sure that when it comes to your investing, if you are looking for long-term investing, then that's where you want to be invested in, are those long-term investments. It's the saying is, and they often use it in real estate. It's not timing the market, it's time in the market. And that's really what's going to get you to your goal. The stock market recently has taken a significant dip, but for those of you who've followed it in the last 3 weeks, that's almost recovered. It's insane how quickly it's bounced back. And I mean, I've been saying it for a while. I'll share a couple of slides again, just to kind of answer that question. Where you should be invested, diversification is absolutely key. If you're looking for a short-term goal where you want your money within 3 to 6 months, then you need to be on an income fund, something that's short-term, something that protects you. But again, the problem is you're not gonna make very much money. The flip side is if you stick to your long-term goal and your long-term vision, stick to that, invest in something that's appropriate for your risk tolerance, and you should be fine. Let me just kind of highlight here. How do I share? Let me just share this slide here. I'll just share a few slides with everybody. Here we go. And just make sure that you can see this. Can you see this? Can you see that, Angie?
I can see it.
Okay, so this kind of highlights, I'll share with you a few slides.
There you go. It's better.
Yeah, so this slide, and I think most of you have seen this slide already, but it showcases what has happened in significant market dips in the last, 50, 80 years. So you look at, the 50s where it's dropped -21 within a 12-month time frame, and it's bounced back 31%. You look at 1982, for example, where it dipped 39%. Mm-hmm. Next 12 months, it grew 87%, right? And then if you look at the absolutes over 5 years, 227% growth,
right,
annualized about 27%. So making sure that you don't deal with the short term, you don't try to time it because nobody can time it. If you were affected by that dip, stay in the markets will recoup. It's actually a good time if you have extra money to put money into the markets, because times show that if the markets dip or they regress, they'll bounce back pretty quickly.
Yeah.
Right? So here's another one that just kind of showcases if you put, and I wish we all put $10,000 in 1956 in the stock market, you would have received 8.93% annualized return. And that's highlighting all these dips in the markets, or in the market, sorry. So these market declines over that many years, even with those dips, you still saw almost a 9% annualized return. So if you put $10,000 in back in 1956, you would have over $1 million, probably about probably about $2 to $3 million.
I like this one, Luigi.
Yeah, so this one is really, really important to understand and internalize. Everybody tries to get in when times are good, and we let our emotions get to the best of us when times are horrible. And the reality is, if it's a long-term plan, it's a long-term goal, don't look at your stocks day to day. Because if you called me a year ago, you would have been asking me for the best marijuana stock that was out there. And I fielded probably 4 or 5 calls a day of people calling me and asking me whether or not they should be in marijuana. And the reality is, if it's that hot of a topic, you probably missed the bubble. And it probably is a bubble, right?
Yeah.
So don't get caught into the rut of buying based on greed and fearing or selling based on fear. You need to ride the course, know it's a long-term plan, and just let your investments do what they do. The individuals managing those funds or managing your investments on a day-to-day, they know how to take advantage of volatile markets, and they know how to reallocate your investments accordingly.
That's all. Yeah, I really like this slide a lot. You keep your emotions out of it.
Yep. And then lastly, I'll take you through something that is really, especially in volatile markets. This one really makes sense now. It's dollar cost averaging. So if you looked at the markets day over day, you saw how they've been reacting over the last, probably almost, few months, let's say.
Yeah.
Markets are extremely volatile. Nobody knows what's going to happen in the next, day or two, week, month, 12-month period. So if you have $10,000, does it make more sense to put all 10,000 into the markets now? Or does it make sense to spread out your payments over a longer period of time? And history has shown that through dollar cost averaging, especially in volatile markets, you should space out your purchases. And that's how you take full advantage of the markets, because nobody knows how the markets are going to react on a day-to-day basis. So this kind of highlights in January, if you bought a stock at $10.20, that stock dips in February. It jumps up in April, drops down in May. So as you're buying, instead of buying at these peaks, because nobody knows when those peaks are, nobody knows when these valleys are. So if you buy it on a monthly basis, you're taking full advantage, and the dollar goes a lot further. So your average cost of that fund or that stock, that investment, ends up being spread out over a larger period of time, which drops your average cost down. So you're getting an actual deal by doing that, and you're actually investing more effectively and getting better return on your investments because of it.
Okay. This is awesome, Luigi. Do you have more slides there? Is that it?
That's it. That's all she wrote.
That's fantastic. Do we have any more questions from our attendees today? I'll just wait a second to see. Don't think so. Okay. Well, Luigi, thank you so much for joining me this morning on our 4th episode of Morning Chats with Angie. I so appreciate it. You're a wealth of knowledge. And I know you said go visit others and talk to other financial advisors and investment advisors, but I highly recommend you, and I feel that just based on your knowledge and your caring of your clients, I highly recommend that at minimum they come see you first. So thank you so much. Thank you for your time today, and I hope everybody got just as much information out of this as I did. So thank you so much.
Awesome. Thank you again for the opportunity. And if anybody wants me to share any one of those slides or the Excel spreadsheet, then please do.
Awesome. And we are going to share this with everybody. And we're going to YouTube it, and we're going to try to put it on Facebook that way. Luigi, I apologize for the IT technical difficulties.
That's all right. Thank you so much. Thanks so much again for the platform and the opportunity. Awesome seeing you.
See you.